Hello, this is part 1 of the lecture series for Chapter 1, which is Introduction to Financial Statements. You should have already read Chapter 1 in your textbook and your notes for Chapter 1. You will need your notes for the lecture, so if you don't have them, please get them now. This first section of our lecture will cover the different forms of business organization, so let's get started. One of the first decisions that must be made when starting a business is the organizational form of the business. Each form has pros and cons, so you must look at your particular situation and determine which is the best for your company. We will discuss 3 forms of organization, beginning with a sole proprietorship. This form is your typical small business. It is owned by only one person, which allows the owner to maintain control. This is one of the biggest advantages of a sole proprietorship. They are relatively easy to set up, which is another advantage of this form. The tax treatment of a sole proprietorship is more favorable than a corporation because the income is taxed only at the individual level, which differs from a corporation, which we'll talk about in just a little bit. This favorable tax treatment is yet another advantage to the sole proprietorship form. The major disadvantage is that the owner is personally liable for the debts of the business because legally the owner and the business are the same entity. The second form is a partnership. This is where 2 or more people decide to go into business together as partners. This form is often used when one person doesn't have the economic resources to start the business and/or a person is needed with unique skills or resources. A similarity with sole proprietorship is the favorable tax treatment. The income is only taxed at the individual level. Another similarity with a sole proprietorship is that the partners are personally liable for the debts of the business because, again, the business is not legally considered an entity separate from its owners. The third form of business organization is the corporation. It is an entity legally separate from its owners. A corporation is owned by stockholders or shareholders, which are individuals and/or other businesses that give money or property to the company in exchange for stock. This stock represents ownership in the company. Any payment to the shareholders is known as dividends. An advantage of a corporation is that it is easier for it to raise funds than a sole proprietorship or a partnership because of 2 reasons. First of all, shares are easier for investors to sell than ownership interest in a sole proprietorship or partnership. And second, investors can invest in corporations with relatively small amounts of money, as opposed to sole proprietorships or partnerships. Another advantage of a corporation stems from the fact that it is a separate legal entity. Because it is separate from its owners, the shareholders are not normally responsible for the debts of the corporation. So, for example, if the corporation gets sued, the personal assets of the owners are normally protected. One disadvantage of the corporate form is unfavorable tax treatment. The income of a corporation is taxed both at the corporate level and the individual level through dividends. Our focus in this class is the corporate form, because the vast majority of business in the United States is transacted through this form. So, in the problems and examples that we work throughout the text, any business referenced in those problems or examples is a corporation, so keep that in mind. This concludes our discussion of forms of business organization. I sure hope you learned something. The next part of our lecture series relates to the users and uses of financial information and communicating with users.